catch up a bit tonight, but I don't think I can catch up all the way. And I want to go back and look through some of the material because I don't want to cut anything out. And I do want to give you everything that I typically do. And so it may involve an extra session. So we may, instead of doing 8 sessions, we may wind up doing 9 sessions, although that's not set in stone yet. I have to really take a look, and I'll get back to you next week on that. Would anybody have a problem if we did an extra session? No problem. Yeah, I'm sure. Okay. Good. Good. Yeah, we can probably do that extra session. All right. So let's see. How come? Okay, here we go. So tonight, let's go through a few things here. Tonight, what I'd like to do, a couple of members sent in some really, really good charts, and I want to highlight those because they made some observations that were really right on and really, really quite salient. And I wanted to I asked their permission to share with everyone else in the class, and they were gracious and granted that permission. So you all benefit from some of the work of others, but they're really useful things to highlight. There are a couple of useful things in those charts to highlight that we haven't gone through before, or if we did, I don't think I really emphasized it, and I want to make sure that we do emphasize it so that we've got it clearly in our minds as we're thinking about trading. So I'm going to go through those charts first, and then I want to complete the major indications of weakness. We had started those the week before the American holiday of Thanksgiving, and we didn't quite complete them because we've been running behind a bit. And so I want to try to complete that. Well, I will complete those tonight because there's only 3 left. And we left off, we had covered top reversals, up thrusts, hidden up thrusts, and I want to cover no demand tonight, pushing down through support, and the buying climax. We'll talk about some of the buying climaxes that occurred, including one recently in gold, and we'll go through that in some detail. Then I want to spend a little bit of time, since we've been talking about weakness, I want to spend a little bit of time on reading tops, the tops of the market. Various markets. We'll look at a currency, we'll look at the stock market, and we will look at, I think, a stock, if I'm not mistaken. Then what I'd like to do is shift gears a little bit and just apply what we've learned so far to a day in the S&Ps. Now, the S&Ps are kind of a funny animal. How many of you trade the S&Ps on a daily basis, or want to trade the S&Ps on a daily basis? I see a bunch of yeses coming in here. Okay, a lot of people do. Now, the S&Ps are a funny market. They're probably the best market to trade, day trading wise, at least that I believe that, and I've been trading them for over a decade now, on a daily basis. But there are days when, in fact, many days where they don't really produce a whole lot. If we get a few points during the course of a day, that's pretty good. But on occasion, and it's not rare occasions, it's frequent enough, but you got to be prepared for it, and you got to be able to sit on your hands when there is nothing going on. But when they do open up, they're really nice. And of course, we want to look at the days when they do open up. And so we'll look at one of those days that occurred last May. It's a very good educational chart to go through. We'll just talk about, we'll kind of go through it section by section. We'll talk about what we've learned that we can apply to the chart as it's unfolding day by day. Okay? All right, and then we'll wrap it up from there. Any questions on the agenda for tonight, or any comments on the agenda, or any questions or comments just in general? No questions. Okay, good. So let's dive right in then. All right, here's a chart from one of the members, which really just is a great chart. And let me get my blue pen here. And let's just go through this. This was the task here was to look at markets and identify the signs of strength that were coming in that we had been talking about, that then lead to an up move in the market. And here you can see some really nice work here. He's got the market coming down. He's got the waves shown here. He's drawing those in by hand, which is fine. You don't need any kind of fancy I mean, we certainly have those things available. The David Weiss's indicator is very nice on that. And if you're interested, I can talk a little bit about that not tonight, but a little bit later in the course, and show you how that works a little bit. But you can do this by hand. I did it by hand for years before I started using his wave chart, or his wave indicator. And you can see that the down waves here are good and lengthy, but then suddenly they start to shorten up, and we have that shortening of the thrust, which this individual highlights. Okay. Notice also, as we talked about shortening of the thrust, we're not coming all the way down to the demand line, right? Just as a little refresh, because we were off for a week. This is our demand line, and then this is our supply line. Okay, and supply has been coming into this market, and we see it coming down, making lower lows and lower highs, so on and so forth. But as we get down here, we're not coming down all the way to the demand line. So one of two things is happening, and only one of two things is happening. Either supply is tiring out, or demand is meeting it at that point. And since the volume is relatively low down here, most likely what's happening is that supply is tiring out. The sellers just aren't selling, that's all. Okay? And we can read it in the waves. We can read it in the shortening of the thrust. We can read it just by using the simple tool of the trend channel and noting that we're not coming all the way down to the bottom of the trend channel, which is what we would expect if the sellers were still fully in control of the market. Okay? Everybody should be able to see that. Okay? Now, here's something that we haven't talked about, but I want you to be aware of. Bar A is he says here, bar A is a bar reversal, and it becomes the support. It's a very good observation. We get this reversal coming in. In other words, it tries to go down below these few bars here, tries to make a new low, and suddenly this market shoots up on this individual bar. Okay, whatever market this is. Medco, it looks like. So notice that this is the largest up bar here since the downtrend began on the biggest volume. Okay, volume is bigger here, pretty much bigger here than anywhere else. Look for that, especially as we're coming down after a trend has been in, a downtrend has been in effect for a while, and suddenly, seemingly out of nowhere, we get a large rally on one or two bars, and the volume starts to come in on that rally. That's what we would call a change of behavior. It's what Wyckoff would call a change of behavior. Prior to this, the larger volume and the larger spreads or ranges down ranges on these bars are on down bars. But now here's a change of behavior. For the first time, we're seeing a large up bar coming in on decent volume. So an easy way to measure this is to look for the largest up bar since the down move began on the biggest volume for an up bar. That almost always indicates a significant change in behavior. Okay, everybody got that? Something we haven't talked about actually in previous classes, but I wanted you to be aware of that because it's a useful tool to know. Now, in a similar vein, we have up waves here, right, that have been going on in this little downtrend, and then suddenly, not only do we break the downtrend channel, not only do we break through the supply line, okay, so demand has overcome supply here, we also have the largest up wave since the downtrend began. And we see volume come in on that, right? So, largest up bar since the downtrend begins on good volume. And now what we look for is the largest up wave. Either or both indicate a change in behavior, something we want to look for. Okay. Now, we come back down to this level where he said bar A becomes support, and it tests down here, and it does so on low volume. And my comments here are in black, and I say volume's the key here. And also the fact that it rallies back up above resistance pretty quickly. And I'm talking about this in here, okay, that we rally and we pushed up above resistance here. So we, oh, I'm sorry, I made a mistake there. I'm talking about down here on this shakeout. We come underneath support from A and this level here that got tested at A. We have a drive down, no volume comes in, and that's where I say the volume is key here. But it's also key coming down as well, because each time we came down, we see volume increasing all the way down here, to some degree at least. And for the first time here, we don't see that volume increasing. Look at the level of that volume compared to each of the down waves here. Okay? And then as we come down, we break down to new lows, and you would think that a breakdown below the previous supports would bring out the sellers, and we would see volume expand and the price spreads expand, right? But it doesn't happen. We can draw a small downtrend channel here. You can see I drew it in, and it comes to the bottom of this downtrend channel, and there's no volume here. So most likely that's a shakeout that we see. And then we get a good solid response back. Volume increases on the down wave, and we push back up above resistance. The waves lengthen here, and you can certainly see the wave lengthening here and the volume come in here. And then we come back down, we test on top of this level of resistance. Remember, resistance becomes support. We see that testing. Good spot to take trades in here on that low volume down in here. Another good spot, if you're nimble and you can see this, would be in here on this shakeout. Hard to do psychologically, no question about it. But it's a good spot to take a trade if you want to get in right down towards the bottom. Easier to do psychologically is in this test in here. Okay, and let me erase a little bit of this because I get. So in here, hard to do psychologically. In here, much easier, because now you've got a number of things going on, and I want to mention that. The easiest place is in here to take a trade, and also, well, it's probably going to come back down in here, would be my guess. And somewhere in here you can take a trade. All right, so there's a question from Lars. Could we call the smaller up wave before that change of behavior also? Yeah, you could. This we have over here. I think you're talking about smaller up wave. you could do that. But the key thing, though, is, Lars, is that we see the down wave. Here's a down wave, here's a down wave, here's a down wave. We see the down waves shortening. The one above one. Yeah, okay. So we see the down wave shortening, and that's our shortening of the thrust. That's highlighting the shortening of the thrust. The idea behind the change of this is a change of behavior, but think about it this way. When we're in a downtrend, we need to see demand come in. So demand, in a way, has to prove itself, or demand has to show itself. The first time we see that, we see a glimpse of it on this bar, on this large bar with the bigger volume. But the first time we really see it is on this up wave here. This is really the first time when demand has overcome supply. We have to see that. We have to see that. Now, often it's a process of going back and forth in a little trading range. And I want to show you something here, which I'm going to highlight even greater on the next chart. We often will see that the market will come back down into a certain level. And you can see that demand comes in here at this level. And so we can say that the testing is coming in. Let me erase this here and just do it again. We see that change of behavior, and we can see that there is a level here where the market trades around. It's kind of like an axis line, if you will, but it's not. It doesn't really mean it's an axis line where it's going to rotate around. This is kind of a key thing in accumulation. The market will keep coming into an area, keep dipping into an area. And you start to look at this, and you can see it here as well. You can see that there was buying coming in, a lot of pumping action up and down, churning in here. And on a broader perspective, there's buying coming in all throughout this level here, and then again down here. Okay? But we want to see that demand prove itself, then watch for it to come back down and into these levels, into these areas. We'll see more of that in a few moments. But here's the observation that's made that I think is just so telling. He says here, with 6 signs of strength in the background, we must judge the stock is going to go up. And the next few days, the stock starts to rally with increasing volume. And I say here, I couldn't say this better myself. With all the sign of strength, it's logical the market would rally. We call this, or David Weiss calls this, telling a Wyckoff story, if you will. Okay? And I'm spending time on this because this is how we get the background lined up for ourselves. This is how we get our mind around the background, and we get ourselves away from looking at the last few bars on the chart and making trades based off of those bars. What we want to do is have the background solidly in mind, and then when the market dips back into those areas, or dips back into what had been resistance and now is support, and we have shortening of the thrust, we have change of behavior, we have the up waves lengthening, we have lack of supply coming in, we have a shakeout, which we talked about, coming in on no volume, we have the rally and the expanded volume, we have testing. All of these signs of strength begin to add up, and there's a story of demand, overall demand overcoming supply here, and it can only lead to one thing, and that is that the market's going to rally. So I want you to get that kind of idea into your mind. This is one of the most important things that we can talk about in this course, is telling yourself a Wyckoff story of stacking up the signs of strength, or if we're looking to go short, the signs of weakness, before we take a trade, and not jumping in on this bar, or because we think that suddenly the down wave is shortened. We don't want to go in here. We want to get a quick move, because the market almost always takes time to unfold. Even on a 5-minute chart on the intraday, it takes a little bit of time for it to develop a little accumulation pattern before it's ready to rally up. So be patient, sit on your hands, wait for these things to occur. You can buy lightly down in here. You can buy, once we've broken up and we've made new highs here, you can buy more heavily. You can add to the position. But wait for that. Be patient. All right, everybody get that? This is such a key thing, such a great observation here. And this is what I meant by, when you do these things, don't just do them mechanically. In other words, when you're looking for indications of strength here, don't just do it mechanically. Think about it. What can you observe here? And this individual observed kind of the $64,000 question, which is things add up, and we get a cumulative momentum of indications of strength. And if you remember when I first said, please, please, please do not treat these things as signals, these signs of strength. Do not treat them as signals. Yes, they are signs of strength, but they are not signals in and of themselves. This is what I meant. This is exactly what I meant. And it's nice to see that one person at least had found, saw this come in. I saw this unfold. Question was, do I know what time frame this is? This looks like maybe a 15-minute chart or a 30-minute chart or an hourly chart. I'm not sure. It's an intraday chart of some sort. I'm not even sure of this market. It looks like a stock, but I'm not positive. No, it's not. Oh, it is. It's a daily. I'm sorry. It's a daily chart. So, is that helpful for people? I mean, it's one of the most important things I can tell you here. And it's, we'll see this more, and I'll try to highlight this more as we go along. Okay? All right, let's take a look at another chart that was submitted by a class member. And another really nice chart here, highlighting a few things. And I'll add some of my own comments here, but this person covers an awful lot of them, and they're really good. Look at what happens here. This is soybeans on a daily chart, okay? And we can see that he says it gets very oversold in the trend channel. The simple little trend channels, and we talked about selling climax last time, and we said that when we look for climax, we want to see that big volume come in, but it's also really important for the trend down to accelerate, and he's got the acceleration of the downtrend here. Notice that we've got high volume over here, but do we have acceleration of the downtrend? No, not really. We're just making that downtrend, and we only go sideways here, just kind of hugging these lows, and then we come back down again on increased volume, breaking down through supports, and we'll talk about that tonight. But we certainly do get oversold in the trend channel, and we see on this bar on big volume that the market rallies up and buyers are able to lift that market up, the close of that market up, and they close at mid-range here. It does come down further, and we see a couple of bars here. Another bottom reversal. Isn't that interesting? Another bottom reversal here, and on good volume, on good solid volume, indicating that buyers were stepping in. Now, here we don't get that immediate gratification of the wave structure changing, do we? This thing just goes sideways for a period of time, a long period of time. Looks like a couple, 3 months in here. And we kind of come down here, kind of choppy. We at this point, or maybe at this point, if we extended this trend channel, we have broken through the downtrend channel, and now sellers are unable to bring it down. They have 1, 2, 3 opportunities here to bring it down lower, and each time they failed to do so. And if the downtrend channel hadn't broken here, it was decisively broken here. If we extend this out, okay? No question about that. come down a little bit here. Some volume comes in on this bar, which is a nice buying, a nice seller. The market was dipped down and buyers stepped right in, and it sprung this level here, this support level. We go a little bit sideways, we get some testing, we rally up, volume comes in on the rally. Even though these are fairly narrow bars, volume comes in on the rally. It gets dropped down one more time for a little test. Very nice depiction of the tests, and very good locating these in the proper area. Okay, very nice. Now we have strength in the background, and suddenly we get testing. Same thing we saw before on the earlier chart. We have a little bit of resistance, a shelf of resistance. The market rallies up. Look at that volume come in. Isn't that beautiful? Just lovely volume coming in on the upside, showing that demand is in control here. We come down to a beautiful test over here. We rally up, we get another little test in a rising market. Each time the market pulls back, it pulls back only for a day or two or maybe three, and the volume immediately dries up. And then look at how this thing just rockets off. Really nice, really nice. Now, let's take a look at this in a little bit more detail here. Again, we can see lots of signs of strength here. And we can also see what we were talking about earlier, a little accumulation zone in here. I highlighted this in red. We see buying coming in here on the climax and below the climax. And then the market spends a lot of time coming back into this level, back into this level, back in, back in, back in, before it finally is ready to take off and rally. This is accumulation. And this is a nice depiction of accumulation. We can also see, if we look carefully here, that each time it comes down, we get good volume coming in, and we get strong reversal type bars here. Okay? Each time we come into this level, we get good, strong reversal type bars. It doesn't always show us this, but here we get them, and that's kind of nice, a nice little key that buyers are coming in. So look at the story we have here. We're oversold in the trend channel. We have a selling climax. We get a bottom reversal. We get a nice long sideways line. Remember last week or the week before I said the longer we go sideways, the greater the odds are that we're going to change the trend. And this is a very long sideways line. It's as long in time as this downtrend, right? And remember what Wyckoff said about wave structure. Change of waves in time and duration. He understood, I think, that time equals volume, because volume accumulates over time. Buying accumulates over time. We get that accumulation occurring. Okay? So that long sideways line, and we can detect accumulation where it keeps dipping down into a specific area, whatever this level was. Volume comes in on the rally. We pointed that out here. As we're rallying up, the volume is coming in nicely here. And that's a sign that demand, that there's no supply, and that demand is coming in aggressively here. Buyers are willing to pay up to get on board this soybean chart. And then all pullbacks are tests. And we know that tests are on narrow range down bars, light volume on those down bars, and it's just indicating that each time it pulls back, no sellers are coming in. Again, we see demand overcoming supply. Very nice chart, and a good Wyckoff story. Okay? When you have that kind of story, you can buy with confidence in here as it's about to leave the trading range. You don't need, okay, you bought down. If you bought down here, you have to sit through all of this. Wait until you see this rally start, and then take that pullback. Look at the kind of move you get out of that. What difference does it make if you miss this little area in here, right? Everybody see that? Everybody see why I talk about being patient and kind of sit on your hands and wait for the right setups to occur. That's important to do. We'll get into trade setups in another week or two. All right, any comments or questions about this chart? Would a point and figure chart give us a target on a chart like this? Yes, it would. Trevor, that's a good question. Point and figure charts would also highlight this long sideways line and would also highlight this accumulation zone. You would see a buildup of the figures in the point and figure chart. And what you would do is you would take a count along this level here. Let me erase this. So we would take a count along this level right in here. And that count on a point and figure chart would project up to some amount here. And we'd have to take that count. You can eyeball this on a regular bar chart. We're not going to get into point and figure charts because it's a whole other way of looking at the market. And it's certainly an important way to look at this market, but you can also see it in here with these. When I talk about long sideways lines, that's one of the things that I always think about in the back of my mind, that I'd see it it would build up the accumulation levels here on a point and figure chart through these sideways lines. So, good question though. All right, everybody should thank the folks who put these charts in. They give us a real nice lesson in accumulation, in change of behavior, in being patient and developing a story as a way to solidify our sense of the background and not be jumping in and out of the market based on a couple of little bars here and there. Okay? Is that helpful for everybody? And let me know what you think about that. Walter says it's very helpful. Good, good. That's the idea here. And Kevin says really good examples. And they are really good examples. They're excellent examples. These are classic. I mean, both of these are jumps across the creek or jump across the creek. You know, we talked a little bit about this. You've got that creek of supply in here, and we start to jump it. We jump it a few times. Little minor signs of strength, a little bit more, and then we get the major sign of strength. But you can also see how important these little test bars are. Start to look for those. Start to look for those because they're really useful. All right, so let's finish up the signs of weakness. And just like signs of strength, we don't want to look at these, as I said last time, we don't want to look at these as signals, but we want to start to piece together a story. We want to be able to tell ourselves a story, and these are the main themes that we're going to use in our story. That's a way to think about it, okay? No demand. This really is a concept that comes out of Tom Williams's work more so than anything else. Wyckoff certainly alluded to the well, more than just alluded, talked about the lack of demand in a market. But it was Tom Williams who sort of codified it, if you will, and put it into something we could more easily identify. So credit goes to Tom Williams for this. No demand. It's a bar pattern. It's kind of the opposite of testing and lack of supply bars or no supply bars. we want to see them only after a sign of weakness. They appear all over the place, but when we're in a good rip-roaring uptrend, we're going to see no demands occur, no demand type bars occur, and we don't want to be, taking a trade off of them because the background isn't with us. We want to put the wind to our sails with the background. We don't want to be, spitting into the wind by taking a single bar and making a trade out of it. Okay, because that's not how the market. It's not how to read the market. So only when we have weakness in the background. Okay, maybe that's a better way of saying it. Only when we have weakness in the background. So what is the no demand? It's a simple up bar on a narrow spread or a narrow range, right? Range or spread, difference between the high and low. We're going to see that little rule of thumb we use, that volume comes in less than the previous couple of bars. Okay. I find them useful in a grinding downtrend, and I think I've got a couple of good examples of that here. I'll show you what I mean. So it's an up bar. In other words, it's closing up. So it tries to rally. The idea here is that it tries to rally. No volume comes in on that rally. And the spread itself, or the range itself, is also narrow, saying that there's no activity. There's not a lot of activity on this bar. There's not a lot of buying coming in. All right. All right. So let's take a look here. Here we have a this is a intraday chart of the S&Ps. Probably a 5-minute chart by the look of it. Here we have kind of one of those sloppy days, right? Here we have a little bit of a trading range that's occurred, and we have a high here. Some selling comes in on that high. Hard to do anything with that. I wouldn't do anything with this. And we come back up, and we see at A for the first, we see that the market peaks over the top here on a little pickup in volume, but can't sustain itself. And on a big wide spread here, it comes down. And it's kind of like a top, a little bit of a top reversal look-alike. We like to see that bar kind of go above the high of the previous bar and then come down. But you can see that on the volume here, there was decent volume that came in. The price just barely held above the high of the resistance, just sitting there, and then it comes down, and we see some halfway decent volume coming in as well. And this is over the noon hour, and so we're going to see kind of light volume. But as we come down, here's that kind of grinding little downtrend I was talking about. As we come down, here are little no demand type bars where the market tries to rally, but the spread is really narrow and there's just no volume behind the rally. And you can see that the volume is very light on those rallies. Okay, and then volume comes in on the down bar. We try to rally up. There's really no demand in here as well. We don't have a specific bar pattern, but you can see that there's just no volume behind that, and the market then comes down again and comes down on pretty good volume. Right now, look at what happens. We get that no demand bar. It's also an inside bar, right? In fact, we're trying to rally up, but it can't even get outside of the range of the previous bar. In fact, the next two bars are like this, and very light volume. That's something you could short on. Another one right here. We rally up. Here we make a high, and we can't hold that high. And look at the volume there. Just saying weakness as we grind our way down. Okay? Everybody see this? Everybody get the idea here on this? We're in a move down. We see some weakness come in, and we can start to look and see that volume come, just like we were talking about before. On the rally bars, the volume comes in, and we saw some strength in the background, so now we've got a story or a reason for buying on those previous charts. Here it's just the opposite. We see a small upthrust, top reversal, whatever we want to call it. The names aren't really that important. It's more that you can see it occurring as we were rallying up. We don't really have much volume coming in. It's getting lighter and lighter throughout the day here. We start to come down, and now we see volume coming into the downside. So now we can say, and we're making lower lows here against this last low. So we can say here that we want to pick up those no demands, right? Now we break down, we make new lows on the day, it looks like, here, and we try to rally up, and look at what happens. We rally up here, we get up above, but it comes down again at A, bar A, and then look, what a picture perfect no demand. It's an inside bar, inside the range of the previous bar. It's an up bar, but the volume is just very, very small, and it can't even close above the resistance level, saying that this market is poised to go down. And the market does indeed start to go down. And now it picks up steam. We see that in the volume. And in the S&Ps at least, the market can have good trends in the afternoon. It's when the trend starts to pick up, you really see it. And we had that today, in fact, in the S&Ps to the upside. So it's just a little tidbit on the afternoons. They can develop trends, and that's what we see here. An inability. We go sideways here all day, all morning long. And then we start to bleed down, a grinding move down. We get that little move up into the resistance level, and then we get the afternoon trend occur. Okay? Everybody get the idea of no demand? It's a nice little marker. But again, we want to pair this with the background. Okay, here we have a slightly different look. We have a market that's rallying up. And if we draw our trend line in, we're getting overbought up here in the trend channel. And at A, we see some pretty good volume on A and the bar before A, and potential supply coming in. The volume is sustained on the bar afterwards. Notice this. At B, we have a little, its volume is less than the previous two. It's narrow range compared to the others. It is technically a no demand bar. But on the very next bar, we come down at C, and we dip down lower, but the close holds. It certainly looks weak here, but we don't have real strong supply coming in on this market, and there's no reason to be taking a trade here because we see no demand. Okay, even though it's overbought and we see some weakness coming in my book at least, it's not enough of a story to put my money on the line and make a trade. Okay, I want to stack the odds up as favorably as I can. We look at the next bar here, D. It's rallying, and it's a nice little rally. Not much volume coming in, right? But truthfully, at that point, you wouldn't know whether this market is going to try to break above A and continue the rally that we've seen all day long, it looks like, or not, or at least the last hour or two. But on E, it tells us a different story. Note we have volume again coming in, same as we have in the area over here at A. And look at the close. Look at what happens. Buyers come in, they rallied up, sellers close it down. Same thing on bar F. Buyers come in, can't even get above A, the resistance at A. Sellers come in and close it underneath the bar, the previous bar. Okay? And then at this B, we see a classic little no demand, followed by weakness. Down a little bit lower, the wave structure has now changed. Here we have overbought, supply overcoming demand, bigger down bars with bigger volume than what we've seen coming up. Remember we talked about that on the upside. Well, now we can talk about it on the downside. Lower low over the previous low. Here's something we'd be interested in thinking about taking a trade on. Okay, this is a no demand that I would be thinking about, not necessarily this one, unless I was being very aggressive and trading fairly light, not a pile of contracts. Okay, makes sense to people? Makes sense to you all? Good, good. Okay, where's the no demand here? Identify the no demand. Take a look at this chart and identify. As you're working up an answer here, let's just take a look. This is a typical day in the S&Ps. We have a little gap open, right? And we do a little churning here. The market rallies up a little bit, and notice what happens. We get a big slug of volume come in, a pop in volume, and we have a the spread or the range on this bar narrows. On all that volume, buyers could not close it above the close of the prior bar. Okay, even though we have this gap open, we come back down and we drop down here, right? We come back into the gap area. Some buying comes in. Gap traders are coming in. You can see the buying, right? On C, see how it dips underneath? We see shortening of the thrust in the price bars, right? To the downside, we see, we haven't talked about this yet, but a clustering of closes here over 20 minutes or so. This is a 5-minute chart. 20, 30 minutes, they haven't been able to go any lower. Then it dips down and comes back into this area, and the volume picks up, and I'll almost guarantee you that that volume comes in on the rally as it's moving up. Okay, so buying comes in here and it's stopping the downtrend. So what's happening here? Is this market stronger or weaker? Well, it rallies back up, and look at what happens on this rally. Where's the volume? How come that volume isn't coming in here to the upside? What's the story here? The story is one of probable weakness. We come up to this level here, D. We rally up, we make a new high here, but we can't hold it. And it immediately reverses and comes back down. And then we go sideways in here. Okay, so there's a lack of demand here. There's a lack of demand. And this is typical in the S&Ps. They gap it open, and it makes a new high, and it looks good, and it excites everybody. But look at the volume here is less than the volume yesterday afternoon on this rally. Okay, so that's another telltale sign. This is also a lack of demand. A little bit different than what we've been talking about, but it's also a lack of demand. Okay, so we have a no demand bar here at B. That's the first one. Notice now this is not less than the previous two bars in terms of volume, but it's still very low volume compared to what we saw here at A. If this was going to hold and turn around, we would expect to see good volume coming in, but we don't see that. Instead, volume comes into the downside. A few people said that there's a no demand here at E, and they're absolutely right. There is a no demand at E. Look at that low volume as it tries to rally up, right? Just nothing there. We see the market come down. We dip underneath here a little bit lower. There's also, this is lack of demand in here, in this area. And we talk about the close being above it needs to be an up bar, but you can sort of see that here's no demand. This is a true no demand here, right? On this bar and this volume, even though it's not less than the previous two, it's just lack of buying coming in. And now we've got an inside bar really here. And there's just no ability to move this market up. So I'd call this a lack of buying in here as well. We just came underneath this support and we start to spring, right? This is a spring. We need to see this market rally, but it's not doing that. It's hugging these lows, and then it breaks down and comes down through this. Now we come back up. Notice the confluence here just before F. We have support in here, which now should become resistance, and we have our downtrend line, which we would draw off of D and E, and we would see there's just a lack of demand at F and at G. Look at G, it's a picture perfect. All right, then the next bar rallies up and comes back down. Okay, bar E and G. Yep, good, Hans, you got that. And Trevor's got B, E, F, and G. Perfect. So you can see that we want to see this in the right location here. And the right location is this nice confluence of trend line. And you can even see we get a little bit of buying coming in. And they're there's an attempt to hold the market up. But look at the rally. Look at it. Look at that two bars before F. There's just nothing there. Nothing on that rally. And we come in, it should rocket off here, and it doesn't do it. It should rally up. And as we come down, volume picks up. And we see the supply come in. Could it be preliminary support? What's that? This in here? Yeah, potentially. I mean, if you're looking at this in terms of a Wyckoff model, most likely on this time frame, this would be preliminary support. We see a little climactic action in here, biggest volume here coming in. We're getting oversold in the trend channel down in here, and most likely this would break the next day. Yeah, where the buying is starting to come in here. That's right. But you know, the S&Ps is a market, and most markets are like this, where there's a lot of testing that goes on, an awful lot of testing that goes on. So buying, you saw on the two charts that class members sent in the large sideways line that happens. So you're sitting there in the S&Ps, and this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 bars. That's an hour here just going sideways. I guess I could have looked down here. It's more than an hour going sideways, and just not going anywhere. Just not able to go anywhere. So yeah, they're buying in here. And I don't remember what happens on this chart. They were buying in here, and maybe this was the preliminary support, and they probably they might have brought it down the next day, dipped it underneath just like they did here. So when we see a gap open, we want to see, in terms of gaps, you want to see strength in the background, right? That's number one. You want to see that strength there in the background. Then if we get a gap opening, you want to see that market take right off. You don't want to see it do this kind of thing. The down wave got bigger than the up wave here. We don't want that. What we want to see is good buying. Okay, let's talk about something called effort versus result. Another Tom Williams idea. It's a two-bar pattern generally. And the way to think about this is that when we get a bar that rallies up and closes firm like this, we expect follow-through. We expect, the market to continue on up. So What we see, though, in this pattern is that we see an up bar, but then the next bar closes on its lows, and it closes below the previous bar that we thought, oh, we've got some rally potential here, okay? And we like to see it rally up above. It's not necessary for it because weakness can just come right in, but we'd like to see the bar rally up above a little bit above the prior bar, and when it fails up there, fails to hold the highs, it's even stronger. And if we see volume come in on this second bar, it just shows that supply is swamping demand at that point, okay? So let's take a look at a couple of examples here. Here's a pretty obvious one where on bar A here, we see the market look like it's going to rally, and it looks like it wants to go right through this resistance level over here. But then look at bar B. Bar B rallies up above A, the high of A, comes crashing down, cannot hold the highs of A, cannot hold the close of A, can't hold the low of A, and in fact wipes out all the buying that occurs on the previous 2 or 3 bars. It erases all of it, and then the market just falls from there. Now, if we look at this, we can see that supply came in here on this bar, right? There's a lack of demand, inability to rally higher. We do rally back up, but look at this rally. There's just not much there, is there? There's not much there on this rally coming back up. And then we come down. This is an hourly chart, the SPY, an hourly chart. This is not an up thrust, it's just a test, or maybe not even quite a test. But this effort to rally followed by the result of just collapse tells you that it's not going to, that the market's going to go down lower. Okay. Here's another example on an intraday chart, on Goldman Sachs 30-minute chart. Here again we gap open one day, it looks strong. We have this bar before A, the bar prior to A wants to rally up. Looks like it's going to continue, right? We're holding the lows in here, everything looks good. Suddenly the market rallies up, fails, comes back down, wipes out the buying that occurred here, and we start to see the grinding move down that we typically or often will see. And then we make a lower low here, and look at what we get, no demand at B. Okay? Hidden up thrust over here, more no demand in here, and more downside movement. Okay? Start to see this in your charts. Start to look for these things. Start to piece them together into, what do I have for a background story here? Here we see a little supply come in at this point on this big volume. We try to rally up on B, and we go a little bit above B and then come crashing down, wiping out all the buying here. See how weak this is? All the buying that occurred in this area is all taken out in one bar, in one 15-minute bar here. And it does try to rally back up, but on no, you can see the volume is drying up as it tries to rally. I'm sorry, that's wrong volume. It's the end of the day here. And it doesn't go anywhere, and then the next day it starts coming down again. Here is another example of it. It's not picture perfect. We didn't go up higher than the previous bar, but we certainly had that effort to go up, and then suddenly it fails and it comes down here, and then the market falls even further. Okay? It's a useful thing to note. It's a useful thing to see. Everybody kind of get the idea? Any questions on this thing that we call effort versus result as a bar pattern? Not just, effort versus result overall. Okay, if you got any questions, go ahead and ask. But in the interest of time, I'll continue to push on. Pushing through support. Just like jumping across the creek, this is falling through the ice. I'll tell you the ice story. when I see those full reversal bars, do you ever trade directly on the close of them? Asks Lars. Not only on the close, but as they're coming down. If the market suddenly breaks, or it looks like it's about to break the prior bar, I will sometimes jump right in. Yep, I will do that. But I've got to have the background good and weak behind me. Okay. Can I show you on the chart? Yeah. If we were looking at this market here, we rally up above the high and it comes down and volume is increasing. I'd be seeing that as it's coming down. So you short it with your stop up here. And yeah, that's what you would do. On the last one, I don't know that I would take one on the last one. You know, you would. It's just taking it in on the close, or as it's breaking down below here. I probably wouldn't do it on this bar. Certainly, I would do it on this. Close in here on this increase in volume coming down. Sure. Okay, pushing through support. This is also called the ICE story. You're welcome, Lars. The idea is, again, the Boy Scout. This comes from Bob Evans. And he had did all the, he had in the late 40s and 50s through the 60s, he was responsible for most of the training that occurred, and did a lot to advance the Wyckoff method in his own right. And this is one of the patterns that he talked about, was falling through the ice. It was about a Boy Scout who's walking along a pond, and the ice is nice and thick. As the market comes down, you know, the Boy Scout is the market here, and the pond, the ice, being the support level. And the pond is nice and thick. However, at some point, the ice gets very thin, and this Boy Scout comes down and falls right through the ice and into the freezing pond or into the freezing river, right? And because it is a river, he's being pushed a little bit by the current. And so as he tries to come back up and find the hole that he fell through, he comes back up and hits his head on the ice, and then falls down, and the market continues to fall down from there. Okay, so that's the ice story. What we want to see is the market falling down through this level, through this trading range, and coming down on widespread, high volume, driving through the support level that occurs to the left. And what it's really doing here, these drives, it's the same thing on the drive up. It's locking traders either into the market. Somebody who's bought here suddenly gets locked in because the market just zips down through here, and they're waiting for a pullback to get out at break even. Or it locks them out of the market. The move is so strong that it scares people and it keeps them from entering the market. So you get locked in or locked out. Okay, and here's just an easy example. We have support here, very weak rally, nothing here. We try to rally up, supply comes in, and then it drives down. And you can see that big drive down and the volume pick up here. Another weak rally in here. We have a no demand, and the market drives down. And again, on good volume. We just go sideways, nothing here, no demand up in here as the market tries to rally up. And again, we drive back down again. And the market then just sort of bleeds down bit by bit. That's driving through or pushing through support. We can see it. Here's a little more subtle way to see it. We have some supply here at A as the market tries to rally up. We get a little upthrust. This is a support level, and the market drives down through on good volume, wide spread. There's our no demand right there. The market tries to come back up. If we extended this out, comes back up and retests the ice over here, but fails and comes back down again. Okay, pretty straightforward, right? Here's the S&Ps on a 15-minute chart the other day. Now, we see the market driving down through support here and down through support. Well, it also can gap down. You can use, in your mind's eye, you can use an average, or not an average, but a true range function, if you will. Does everybody know what true range is? Do you want me to explain it? I'll be happy to do that. Just let me know if you need it explained. Let me just explain it. It's easier to do. The true range is, the range of the bar is the difference between the high and the low. Okay? When a market gaps, there's either overnight activity or overnight event that causes this gap. And so what we do in terms of true range, because the range here is let's call this, say, 10 points, right? But the market fell from 20 points higher, so it's more like 30 points. Okay, so what we do for true range is we take the close on a gap like this. We take the close and we extend the range of the bar from the close of the previous bar. So if in your mind's eye you just sort of drew that range in there and thought of this bar as true range rather than just the gap and the range, then you have that market driving down, pushing through. Everybody see that okay? Same thing here. You can extend true range on this gap, and you can see that the volume picks up, and certainly the volume picks up over here as well, and drives right through. Okay? Make sense to everybody? So pushing down through support, and then we see the weak rally occurring over here, and these are short opportunities in here. This one didn't go anywhere this time. Short opportunity in here, no demand in here on a test of the short. Another short opportunity over here, driving down and through. This is over several days of, I think this was last week in the S&Ps. Is there a difference between an upthrust and the examples of effort versus result? Yes, Kevin, there is. It's a good question. Let's go back up to that. You can see here, for example, there's no upthrust here, right? An upthrust requires an old high in the background. So this would be a resistance level where the market was pushed back down. Then the market comes back up, peaks up above that level, and then falls from there. Okay, so there must be a resistance level in the background that the market then rallies up above, cannot continue higher, fails to follow through to the upside, comes down. That's our upthrust. Okay. Here in effort versus result, we have the effort to rally up, but on the very next bar, the supply swamps it, and swamps it decisively. That's effort versus result, weakness in its own right. We don't have any old resistance level in the background, at least that we can see on this chart. Same thing over here, we rally up, and the market gets swamped with supply here. Again, no resistance level. You could say, I guess, that this is a resistance level. So, okay, skip that. We wouldn't say that. But over here, there's none. And that's the main difference. Okay, that should be clear. Good question, though. Here, Kevin, we have an upthrust, right? It's a 2-bar up thrust or a top reversal, but it's an up thrust nevertheless. Had this market closed on its high like this, and then this market rallied up and then came down and closed like this, we would also say that there was an effort to rally it up, the market up thrusted, and the result was pretty poor. So we would have a combination of those two at the same time, and that's because there's a resistance level here that we would lean against in terms of structure. Okay, but it didn't happen quite that way, but it could happen simultaneously. All right, let's talk about buying climaxes. It's the reverse of a selling climax. We're going to see big volume come in. We're going to see that stride accelerate, or that angle of ascent steepen. We're going to see wide price bars, wide ranges on the price bars. And rather than closing on the highs, we're going to see it close closer to the middle or the low, and we're going to see the market start to fall from there. Right? So let's see what it looks like here. I didn't draw in the trend lines here. I should do that. But you can see that the market had been coming down. This is a small intraday chart. We get a little spring here. The markets find some support. It starts to rally up. And we get overbought here in the trend channel very quickly. And if we drew in a resistance, well, this had been support and turned into resistance. Now we're at resistance again. We see big volume, the biggest volume here coming in. Here's another clue. The biggest volume in the uptrend occurring at overbought signifies the potential for a selling climax. Buying climax. The close is in the middle of the range. If all of this was buying, we would see this bar, in fact, be bigger. Let's just give you the sense here. You can see on the bar before A, we go up and close nice and firm on that volume. On bar A, we have substantially more volume than the previous bar. We have a range or a spread that's smaller, and we're closing in the middle. Supply is coming in. Okay, we're also accelerating our trend going up here, especially the last couple of bars. This is just an intraday chart. So, and then what we expect to see is a sign of weakness, supply coming in, and there it is. We're coming down, and volume is picking up to the downside. You get a couple of no demands in here. The market starts to fall a little bit more. Okay, that's climactic action. Here's another indication of buying climax. And by the way, you're going to see, I think you're going to see more selling climaxes, especially in in instruments like the S&Ps, the indices and stuff. You won't see as many buying climaxes as you will selling climaxes. Fear seems to be a greater motivator. And seems to be, it becomes more clear in the charts. But you can certainly see that if we had extended this green trend line here, that the market's certainly overbought. We can see at A that the volume is coming in over here, and then it dies out up above, but we still have pretty good volume. And if this were all buying in here, in these couple of bars, and you can see certainly that the spread's narrow and such. If this was all buying, we would expect to see this market continue to go higher, but instead it's not. It's closing in the middle on pretty high volume. Then the market starts to come down. Notice the volume increases, and here we don't go down after that, we just go sideways, but it does certainly change the direction of the market. Here's one I had to really crimp down because I wanted you all to see this. This is gold, recent gold. This was in September. We see this selling climax in gold. And you can see that this is a daily chart, and you can see that we were in a long uptrend. Everybody wanted to buy it. And you know, the theory about this is that people wanted to buy. They wish they could have bought down here, and they see the market rally up. And now it's up to this point, and they wish they were at least able to buy down here, and now it's up to this point, and so on. And they're seeing it now start to really accelerate up. Every day, you can see the stride accelerate here. It starts to accelerate here. It really starts cooking here, right? And it's almost like they just can't not sit on their hands. They have to get in because they hear about everybody making tons and tons of money on gold. Well, for those of us who can read the chart, we can see that it's way, way overbought. And we see the huge volume coming in. And you see the angle of ascent steepen. And you know, we'll look at this in more detail in a little bit, but you can see, you'll know that these price spreads are really wide. And you can see the churning start to occur up here. We'll look at this in detail. And look at the fall that it has. You know, this was incredible. We saw this. I was in India when this occurred, and I put this into a chart and sent it off for a seminar that I did for Traders Library. And I was putting together charts at the time, and I said, look, we're going to talk about this when I get back from India, and we're going to see that this occurred. And indeed, it did occur. Right down. Any questions on buying climaxes before we move on here? I don't see any questions, but if you have any, please go ahead and ask. I'll do my best to answer. So, let's take a little bit of time now and look at a couple of tops and how we can read weakness in the tops. Okay? This is, well, I'll tell you what this is afterwards. But you can see that we are rallying up. Does anybody see anything prior to A that would cause any kind of, if you were long this market, any kind of discomfort or any kind of suspicion that that all things may not be copacetic? Anybody see anything that stands out in anything prior to bar A here? Ronald says the widespread down bar here, right, Ron? 9 bars back, high volume, 1, 2, 3, 4, 5, 6, 7, 8, 9. Yes, good, good. Heavy volume on the downside. Exactly. Remember we were talking about how a change of behavior begins to occur when we see the widest spread or widest range of the bar in the opposite direction on the biggest volume that we've seen since the move began. So here we're in an uptrend, and I understand we don't have all the background for us, but we're in this uptrend, and look at this bar. Look at this bar that you picked out, and look at the volume that came in, wiping out 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 weeks. This is a weekly chart. 15 weeks of buying. Okay? 15 weeks of buying. Now, it turns right around the next week and rallies back up. Okay? But this is something you note. You would want to note. Okay? So it rallies back up, and on bar A, it looks like it wants to push up higher. We're at a little bit of resistance here from this big bar coming down, and we're trying to negotiate up higher. And it wouldn't be a surprise to see some difficulty, but by the at bar A, everything looks okay. We drop down here to B, and we see a little volume pickup, but the close is still above the close of the prior bar, so it's looking okay. It looks like it wants to try to rally, and indeed it does. But what happens now on bar C? What do you see here? What do you notice on bar C? What can we notice here? Some heavy volume coming in, right? And closing back underneath the resistance level. So it's telling us that supply is having a say in here, that it's hard to move this market up, isn't it? Right? It's hard to move this market up. On D, it does move back up. It does drive back up again. And things look like they're maybe okay, right? Volume is a little less, but not substantially. Not substantially less. What happens on E? We're getting a repeat of C, aren't we? We saw a high volume on C. We're seeing high volume on E. And we're seeing the market drop down, push down. On F, though, it goes underneath and rallies back up again. But then it drops down, and again on G we see high volume. What's happening here? Does anybody have a sense of what's going on? Anybody have an idea about what's happening here with this and why it's happening? Anybody? They're coming into a buying area? You mean that because of the resistance here? Maybe. Accumulation? No, I wouldn't call this accumulation. Selling area, you meant. Yes, that's right. It's coming into a selling area. Distribution. Good, Nicholas. It is distribution, in fact. This is early distribution. Look at what's happening here. Look at what's happening. First of all, this is this bluish line here. You can see runs in the middle. That's the average volume for the last 20 bars, I think. Okay? And you can see that we got well above average when we came down, and everybody noted that there was some supply that came in here. Now, up here, between A, really, and G, we also have above average volume, don't we? If we looked at this, and we just boxed it in here, put a box around this, and you can certainly see by the volume average, we're way bigger than all of this that was going on this uptrend here. Everybody see that? Everybody see that? Let me know that you can see that with a Y or a yes. I want to make sure that you guys are seeing this. Okay? All right. So suddenly we have big volume coming in here, above average volume. And what's the market doing? Well, it's trying to rally up and it comes back down. It rallies back up, it comes back down. Up, down. It's pumping up and down in here. Okay? That's selling. That's distribution. If that were buying, if we were going to go higher on all this volume, we'd be moving up. Okay? We'd be moving up. There's certainly a lot of buying going in there. There's certainly a lot of buying going on in there. But there's also a lot of selling. There's more selling than buying. How do we know? Well, as Lars says, there's a divergence between the effort and the result. The effort in this instance, it's not the price bar pattern, but just overall. The effort here is the volume, right? It's the fuel driving the market. So there's an effort to rally this market up. But the result is that it's being capped here, that somebody is stepping on top of this market. In other words, there's lots of buying, but every time somebody's coming in to buy, somebody else is meeting that buying and selling into it. Okay? Everybody see that? Go ahead, Asta. Turn on the light for you. Everybody see that? There's an effort to rally the market because of the volume, but the result is that it's going nowhere. Okay, what do we have on bar H? I don't think I have the volume labeled, but I'll click it here. What do we have on bar H now? While you guys are thinking about what bar H is, Walter has a question. He says, wouldn't this also be the case when we have absorption? Yes, absolutely, Walter. We would see this in absorption as well. But in absorption, we would be having some sort of a down move, and then we would see the churning action and the high volume down here at the bottom of a down move. Okay, here we've been in an uptrend. I couldn't put everything. Couldn't put it all on the chart, but this had been in a long uptrend, and now we're churning up here with the above average volume. And H is absolutely right. It's no demand. We try to rally up, and look at, there's just no buying behind that. It tries one more time at I to rally up, and sellers came in and pushed it down, and then on J the volume increases and we start to slide down, right? And then look what happens on K and the bar after K, and then on M and the bar after M. But certainly this is the largest weekly volume that we see on this chart, and it is the widest break we have on this chart. Okay, and we put in a lower low. Now, some people will think that this is a spring, and the market does dip down on M and rallies up, and we get 2 weeks of trying to go lower, and the market gets held. But boy, oh boy, this is not a spring I would really want to. I mean, it was a spring, and it does get tested over here at N. We dip back into this area, and we're on much lighter volume than we were when we dipped underneath. But this supply, this is not one of those springs that I would be thinking about buying. This supply was pretty negative. It does rally up, but look at what happens when we get back up into this supply level. On O, the volume starts to diminish. How come, you can ask yourself, how come it is that there was bigger volume over here, and now when we come back up into that same level, volume is markedly lower. It's below average now. And then look at what happens on P. We just poke up above, and there's just no demand there. There's just no ability to rally the market. Okay? So what happens? The market falls. On Q, we wipe out 1, 2, 3, 4 weeks worth of buying coming off of this spring. And we do it in 1 week. And the volume isn't all that excessive either. Right? It's not all that excessive. Saying that it doesn't take much to push this market down. We try to rally up, and we get, certainly on a daily chart, on R, in this area, we would see the hidden up thrusts and an opportunity probably to potentially go short. We come back down again. Volume is sustained on the down move. Volume is sustained on the down move. We try to rally up, and we get hardly anywhere. We have another hidden up thrust here. It would be more of an up thrust on a daily chart. Just no volume in there to rally up, and then the market comes back down. Okay, a couple of questions here. Come on in, Asta. Kevin says, no volume when demand is trying to push higher. Low spread, high closing, up bar on low volume. Yep, that's right. That's up in here, right? Just no volume. Absorption could be in an uptrend, couldn't it? It could be, It could be, Walter, but we wouldn't see it occur too much after something like this, too often after something like this. And also, if we saw demand come in, it wouldn't be happening at the top as we're trying to push higher. Absorption is going to, not absorption, absorption could be in an uptrend. Yeah, absorption could be in an uptrend. However, we would see I'm sorry, what I was just talking about was accumulation. I misread what you said there. Absorption would come in if we saw some weakness here and we had a resistance level, an all top up here. So there would be a resistance, and we saw supply come in, and the market's now trying to absorb through that. Go back and look at the charts on absorption. That's right. But when it's just in new high ground here, new high ground, right? When the market is up there in new highs, and we see this, and we see this pumping action, that would not be absorption, and it certainly wouldn't be accumulation. It would be just the opposite. All right. So anybody have an idea what this market was? This was IWM on a weekly basis. And here is the area we just went through. And this was late 2007 into early 2009. That set the stage for that large bear market. Early 2008, I think, not 2009. But when late 2007, early 2009 bear market, that was the beginning of it. And this was the preliminary distribution in here, and secondary distribution occurred over in here. And just like in accumulation, you can see that supply initially came in this area, and look at where we see it all throughout here, that supply coming in, and also up in here, of course. So primary distribution, secondary distribution, and then it plummets. Notice how we get climactic in here. We tested a couple of times. We tested on very low volume this spring, and this was the low in March of 2009. Yeah, the whole chart being shown could be a change of behavior on an even larger time frame. And that's right, Lars. And that's a good way to think about it. Try to think about different time frames, because it would be a change of behavior on an even larger time scale. So let's take a look. Here's a recent chart of the euro currency on a daily basis. Let's take a look at looking at how to read some tops here. On bar 1, we're pushing up through a supply level here, an old resistance level. On good volume, it gets tested the next bar. We drive up again, and look at the nice little test on 2. Look at the light volume there. Drives up, good volume, drives up, good volume. I'm sorry, that's wrong volume. We test again, test in a rising market on bar 3. We drive up, good volume. What happens at 4? What happens at 4? What's different about 4 than the other price bars that we've been highlighting with the high volume? Closes in the middle of the range, right? Yeah. So, and it's a down bar, and it's closing on high volume. Effort versus result. Exactly. Here, the effort's strong and the result is good on each of these rallies here, rally bars. The effort is good, the result is strong. Here, let me erase this. On bar 4, Notice we got the highest volume in quite some time, and the market stalls here. Now, does that mean it's going to go straight down? No. What does it mean? It means that we're likely due for some sort of a pullback or correction. Maybe it'll turn into a larger top, but right now we've had good demand coming up, so we'd be looking more for a pullback of some sort. Okay? We rally up again. Look at what happens here on the bar before 5. We try to make new highs, and we do, but the volume is not in keeping with all these other rally bars, is it? And then on bar 5, we again see even bigger volume than on bar 4, about the same volume, a little bit bigger. And what happens? It's one of those top reversals or effort versus result kind of lookalikes. It's not quite clear, quite as clean as we would like to see. But it certainly does close on good volume, and now it's closing underneath the resistance level from bar 4. Everybody see that? Okay, we see supply coming in. Now there's a buildup of supply and a little bit of lack of demand in here. Somebody's selling out in here. On the push down to 6, notice what happens. For the first time in this rally, we get a widespread down bar with big volume. Right? Everybody see this? Every time prior to this, every down bar was fairly narrow spread and light volume. Volume dried up on the reaction each time. This is the first time volume increases. Everybody see this? Let me see. Let me have a Y or a yes. Yes, it's a big market tell. It's a big market tell. Wyckoff would say that this is breaking the backbone of this little rally in here. And this is a pretty straight up run if you look at it. Then you can expect a decent pullback in here. But you're breaking down in here, and it really is. Now the next bar rallies back up again, but it doesn't wipe this supply out. It doesn't wipe this supply away. Okay? We come back into this area and we do test it, and the volume's lighter, and that allows the market to rally up. But let's go a little bit further here with this. Okay? Add a little trend line in here, and what happens? We rally up to bar 7, that's this bar here, on pretty good volume, right? And it looks like at this point, maybe this thing is going to rally up. But what happens on the next bar, the bar after bar 7? Pretty much sustained volume. We get a little bit higher, but the close is in the middle. And then on bar 8, we drop underneath on big volume. Okay? This says that we're going to see some sort of a pullback. We're going to see some sort of a pullback in here. There's been some distribution starting at least in this area here. Continued over here, selling on the down move over here. An attempt to rally up, fairly light volume on the rally until we get up to that high again. And then once again we see that sustained volume, just like we saw earlier. And that effort versus result, not so much in the price bars, but in the overall idea that there's effort to rally this market in the volume, and the result is pretty poor. Okay. Why should we not see it as buying coming in on the large down volume, since next bar coming in is full reversal, bar 6? Well, because we're seeing, Lars, it's a good question. If it were a shakeout, we would not see the large volume coming in. The volume would be less than that. It would be down in here somewhere. But because we see the large volume, it's a distinct change of behavior. Prior to this, we see narrow pullbacks, small pullbacks, very short-lived pullbacks. This is the longest lived pullback, and it's on the biggest volume and the biggest bar coming down. Also, if we look at the waves, I mean, these, you'd have to get pretty small waves in here, but you'd see that these are pretty light waves, and suddenly we're making a big wave in here as well. Okay, so could it be buying? Yes, it could be buying. And was there buying coming in? Sure, there was. Of course there was, because the next bar rallies up. But the market was weak at this point. These are the subtle telltale signs of weakness in the market. Okay, not strength coming in, but weakness. It's just like we saw on that big down bar on the weekly chart of IWM prior to this, and then the market rallies up, and it takes some time for it to come up. So what happens? We fail here to go higher. This is where we left off on the last chart. We fail. Now we make a lower low. We see it coming down on sustained volume. This is big volume coming in here, right? Very big volume coming in. This is weakness. And then we rally up. We have a hidden up thrust in here right at resistance, well, support, which turns into resistance. And a nice trade there. Okay? So Kevin says, would you sell at 140? I would look at it on an hourly chart and look for opportunities to go short. And if I caught a good move and it's closing firm in here, I'd probably stay. But the best trade, really, the safest trade, is right in here at 10, where we rally up on no demand and then flip over in a hidden up thrust type of a move, and we see volume come in. There's the best spot to take the trade. I wait. I'm pretty patient and not trying to jump through. Also, when we look at the waves here, we want to kind of include those and not forget them. When we were talking about choppy little waves coming up. But we see here big up wave in green, and then a down wave in red, shortening up wave in green, increasing down wave in red, short up wave in green. What do we expect? Another leg like the last one down here. Okay? And we can, tie in our trend channel. If we did that here, taking a trade at 10, we tie in the trend channel, and it gives us a sense of where we're oversold in the trend channel and where volume comes in. Okay, it's the same kinds of things repeated over and over. Okay, here's any questions on that chart, by the way. That's the euro currency. Any questions on this? Okay, if you got one, go ahead and ask. I'm going to just continue in the interest of time. Here we have, this is that gold chart that I was talking about earlier. And again, we were in this large trend up, and we see this market, if we drew that, even just taking it from this chart here, trend channel, we're clearly overbought in the trend channel. As we get overbought here at 1 and at 2, we see supply coming in. We see the big volume, bigger than anything on this chart, and it's in overbought territory, and we see negativity enter the market. But the market rallies up. It holds in here, rallies up. We come up into this 1900 level. We see shortening of the thrust in the price bars. On bar 3 here, we try to rally up higher, can't hold it, come down on big volume, and then we see follow through on bar 4. Okay, this is buying, this is climactic action in here, this buying climax. And then the market gives us, lack of real demand here. Maybe it'll rally up higher, we'll see. But on bar 6, we see very, very large volume, and we see that up thrust occurring. Okay, and then we just come down, we see no demands at 8 and 9, and then the market showing us that the market is unable to rally off of that this area here, and then the market plummets. And what a move, huh? What a big move that was. So that's a nice example of a longer kind of selling climax. And we had talked about point and figure charts earlier. You can see that in this level here we have supply distribution occurring all across here, and certainly across this level as well. And if you did a point and figure chart, it probably would give you counts similar to the level that it fell. Any questions on that chart? Any questions on any of these charts looking at tops? These are all fairly significant tops that we're talking about. And you can see, you'll see, look at the volume. This is a daily chart, and look at this huge volume coming in here. We don't see anything like that all the way up. And we have it when we're overbought and the stride had steepened. Yeah, pretty clear, but you have to do some rewiring. That's right. You have to think differently. One last point that I wanted to make on this is the wave structure. We were rallying up and we didn't get much of a down wave here. We get a little bit of a shortening in the up wave, and then we get that big down wave on big volume. And it's just telling us that this is a sign of weakness in here. There's supply coming into the market. Then we want to lean against, if we can find a up thrust trade up in here, that's a nice one. I'm sure on a 60-minute chart there would be nice hidden up thrusts and stuff as well. All right, let's take a look at and try to pull some of the stuff that we've been learning over the last several weeks, try to pull some of it together. And let's just go through and take a look at this S&P chart and see what we can see. What are we seeing immediately on bar 1 here? We gap open, but what is it that we see? What's the story just on this first 5 minutes of the S&Ps? What can we surmise from this if we're trying to day trade this? It's a gap open. Should we go long here? It's a gap up. Should we try to go long? The bar's closing in the middle on high volume, so it says some supply is coming in, right? Exactly. It's not something that we want to be buying there because we see some supply coming in, even though it's gapping open. This is one of those false gaps. Is it where we would sell? I wouldn't sell there. You might, if you were very aggressive and you're nimble on all of this, but I'm not suggesting that you do that. Look and notice as we come down what's happening with the volume. It's not diminishing as we go down, is it? In fact, it was being sustained. Somebody was selling in as the market was moving down. Somebody, I mean traders, were selling in to it as the market was moving down. Notice the rally coming back up. Look at the volume. Is that market expanding on the rally? Is that volume expanding on the rally? Does this look like a strong rally to us? No, it doesn't, does it? In fact, when we get up to the resistance level here, let me just show that here. When we get up to the resistance level, we see a little pop in volume, and the spread narrows down. It's not like we're trying to rally up here, right? Suggesting that some supply was potentially coming in where we saw it come in earlier. And look at what happens here on bar 16. We go sideways a little bit. We try to rally up. Was there any volume there? Was there any demand? No, none whatsoever. In fact, we dip down a little bit and volume tends to increase just a little bit. It's hard to read that. Nothing really there to really read. But as we try to come back up to that level at 1, look at what happens. We just have no demand there. there's just no demand. And not a surprise that the market then starts to fall here. Okay? So, aggressive trading, you could place a position on in here if you wanted to. Kind of hard to do, truthfully. I think you'd have to be sitting on your hands, and this is just one of those days in the S&Ps where there's not a lot we can do until we come to this level over here. We come down. Now we can see that in terms of waves, we've got a bigger wave coming down here. We certainly have supply coming into the downside. We've made lower low. We're trying to hold on here, trying desperately to hold on, but there's no volume coming in. We rally up. Look at the bar before 34. Look at that volume. Just nothing there. No demand. Right? We can place a little trend line across there as just a small resistance point because we tried to come up at this level before, and now we start to fall down. We can add a trend line in here, and we see that we get oversold in the trend channel right where we would expect it to get oversold. And we also can key off of this level down here. I don't think I put that in. Okay. So we can go a little further here and extend our morning low, the early morning low that was put in at 4. We can extend that across, and we see the market comes back up to this level again, and once again gives us no demand. When the market comes up after it's been trying to rally and suddenly has a little pop in volume, and either that bar or the next bar is closing poorly, it's most likely that that trend is over. Especially, look at this. Look at how this is rallying. Is there any demand on this rally? No. Right? We can see that. There's just really no demand. And now it comes into that level. This is a good spot to place a trade. And this is probably the choice point because this is a fall through the ice. Here's our ice level in here, if you will. Right? We fall through it here, and now the river, the current pushes us downstream. We're trying to come back up to that place where we fell through, the hole in the ice, but we can't find it. We bump our head on the ice again here, and we just come down. All right? And we can see that ice story even on a little time frame, or even on not a little time frame, this is a little time frame, but even on a smaller scale, where we had a little support level here, the market tried to hold, goes sideways, it drops down, the current causes us to drift a little bit, we try to rally back up. Look at this bar here, look at the rally on that bar, the bar before 70, that's that volume right there. There's nothing there. So we bump our head again on the ice, this red line depicting the ice, and we fall down further. Right? And once again, we can use trend channels that help us identify where we want to exit out of a trade when we're in a trade. Okay? Now, this kind of pulls all the stuff that we've been talking about together. Yeah, Kevin points out that the morning low is also a good level for what the market profile folks call the initial balance, or the first hour of trading. And the first hour of trading is always useful. And the initial balance would be, from about 10:30. So it would be roughly, I would put it in from bar 13 as the high down to 4. And we break down, and it's useful if you're trading the S&Ps. It's one of the things you want to pay attention to. Are we within the first hour's range? And if we were just kind of cranking back and forth between the first hour's range, maybe dipping up above it and coming down below it, then it's one of those days where we're going to be lucky to pull out 2 or 3 points in the S&Ps. But like today, where we break down below it, and we do so with that pushing down through support, that driving down with the good volume. Yes, it gets oversold down here, but we still drove down, and then the rally back up is very weak and lackluster. And then we can bring in the idea of support turning into resistance and staying as resistance over here, or the ice story, and we can again see the lack of demand up there as a place to take a trade. Okay, so yeah, you can definitely use ideas out of market profile theory. I did some study on that, quite a bit of study on that, in fact, and there's certainly some legs to it, particularly the initial balance or the first hour's range. And also, I found that the high value areas, the high value nodes are very useful in trading the S&Ps as well. Excuse me. All right, so that kind of pulls things together. Now, as I said, not every day in the S&Ps, said this in the beginning, not every day in the S&Ps acts like this. But there are days where we get, good moves like this, good swings like this. And this happened to be one of them. And when we start to see this, the S&Ps are a very good Wyckoff-related market to trade, because when they do move, they tend to be well behaved like this, and we can lean against support and resistance and use that to our advantage. All right, any questions on this? If not, let me give you a little recommended assignment for next week, and it's in two parts. The first part is, whether you're a day trader or you're a swing trader, identify now these indications of strength and indications of weakness. If you're a day trader, go through the last month's worth of intraday charts. If you're a swing trader, go through last year's daily charts, or whatever time frame you trade. If you're trading the hourlies, then go through the last 6 months worth of data. Locate your trend lines and highlight the waves. Look for locations for trade setups. It's the same thing for both swing traders and day traders. And what I should say is, make a story. Make a Wyckoff story about the background before you, to legitimize the location of a trade. Make a story. That's important. Okay, part two on the chart that follows this. It's Alcoa, a weekly chart of Alcoa. Use this chart and identify signs of strength and signs of weakness, and locate those trend lines and highlight the waves, and identify locations for the trade setups. And we'll talk about this next week. Okay, and here is the chart right here. So, any questions about anything we've covered tonight, or the suggested assignment, or anything at all? And I'll pause for a moment or two. All right, I'm not seeing any questions coming in, so I will, here's a question. I knew there'd be one. Do you only trade ES or review daily charts of other instruments that could be showing signs of Wyckoff strength or weakness? I look at several different charts. I look at several different markets. I primarily just trade the S&Ps. That's my main market, but I do swing trade some of the other futures, and some ETFs and some individual stocks as well. But probably 80% of my trading is the S&Ps. All right, everybody. Good. Glad you got something out of it. I hope it was helpful for everyone. And have a great week trading, and I will see you next Wednesday at 4:30. And then I'll go through the rest of the schedule for this and determine whether we're going to need an extra session or not, which I think we probably will, but I'll let you know next week. All right, everyone, have a great trading week. Have a great week, and I will see you next Wednesday. Take care now. Bye-bye.